Let me ask you something. Think back to 5 years ago. What was your income then compared to what it is today? For most people watching this, income has gone up, maybe modestly, maybe significantly. Now ask yourself the second question. Are you saving and investing meaningfully more today than you were 5 years ago? For the overwhelming majority of people, the honest answer is no. Income went up, lifestyle went up with it, and the financial position today looks remarkably similar to what it looked like 5 years ago, just at a higher price point. That is lifestyle inflation in action, and most people who experience it never calculate what it is actually costing them. Not the surface cost, the slightly higher rent, the upgraded car, the better restaurants, but the real cost, the compound cost. The cost measured not in today's dollars, but in what those dollars would have become if they had been invested instead of spent on upgrading a lifestyle that was already perfectly functional. Today, we are doing exactly that calculation. We are going to look at the real, full, long-term cost of lifestyle inflation with specific numbers, specific examples, and the kind of honest accounting that most personal finance content avoids because the numbers are genuinely uncomfortable. By the end of this video, you will have a completely different relationship with the phrase, "It is only a little more per month." Let's get into it. What lifestyle inflation actually is. Lifestyle inflation is the pattern where spending increases proportionally with income, leaving the gap between earnings and expenses, and therefore the amount available to build wealth, essentially unchanged regardless of how much more is being earned. It is not always dramatic. It rarely involves conscious decisions to significantly upgrade your life. It happens gradually, incrementally, through dozens of small and individually reasonable choices that collectively consume every dollar of income growth before it can be saved or invested. You get a raise and decide your current apartment is a little cramped. You move somewhere nicer for an extra $300 a month. Your commute feels stressful in your older car, so you lease something newer for an extra $250 a month. You are earning more, so you start eating out more frequently, spending an extra $200 a month on food. You join a gym you actually like for $80 a month. You upgrade your phone plan. You start buying better wine. None of these individually feels like a significant lifestyle upgrade. Together, they have consumed $830 per month of income growth, money that was supposed to feel like a raise but has entirely disappeared into a marginally more comfortable version of the same financial position. The particularly insidious quality of lifestyle inflation is that it does not feel like a mistake while it is happening. Each upgrade feels earned and reasonable. The new apartment is genuinely nicer. The newer car is genuinely more comfortable. The better restaurants are genuinely more enjoyable. You're not making irrational decisions, you're making individually logical ones that collectively add up to a financially damaging pattern. That is what makes it so difficult to resist without a deliberate and pre-committed strategy for managing income growth. The surface cost versus the real cost. Most people evaluate lifestyle upgrades by their immediate monthly cost. The nicer apartment costs $400 more per month. The car lease costs $300 more per month. The upgraded gym membership costs $50 more per month. These numbers feel manageable, even small relative to a growing income. But this is the wrong way to measure the cost of a lifestyle decision. The right way is to measure the opportunity cost, what that money would have become if invested over the remaining years of your working life. Let's put real numbers on this. Suppose you get a raise at age 30 that increases your monthly income by $1,000. Instead of investing that $1,000 each month, you allow your lifestyle to absorb it. A nicer apartment, a car upgrade, dining out more often. At a 10% average annual investment return over 35 years until age 65, that $1,000 per month would have grown to approximately $3.8 million. The lifestyle upgrade did not cost $1,000 a month. It cost $3.8 million in foregone retirement wealth. That number is not meant to paralyze you. It is meant to make the true cost of lifestyle inflation visible in a way that the surface cost never does. Most people would think much harder about upgrading their apartment by $400 a month if they understood that the real 35-year cost of that decision at a 10% return is approximately $1.5 million in compound growth. Not $400, not $4,800 a year, $1.5 million. Seeing the opportunity cost changes the emotional weight of the decision entirely. The raise that never felt like a raise. One of the most common and most frustrating experiences in personal finance is getting a meaningful raise and feeling, within 6 months, as though nothing has really changed. The paycheck is bigger, the lifestyle feels slightly better, but the savings account looks the same. The investment contributions have not increased. The financial position has not fundamentally improved. The raise arrived and then somehow quietly disappeared. This experience is so common that behavioral economists have given it a name: the hedonic treadmill, the tendency for people to quickly adapt to improvements in their circumstances and return to a relatively stable baseline level of satisfaction. The new apartment feels luxurious for 2 months and then just feels like where you live. The newer car feels exciting for a season and then just feels like your car. The upgrade in experience does not persist, but the upgrade in cost does. And each adaptation to a higher lifestyle cost raises the floor of what feels normal and acceptable, making it progressively harder to scale back even when financial circumstances would benefit from doing so. The antidote to the raise that never felt like a raise is a commitment made before the raise arrives, a pre-commitment to direct a specific percentage of every income increase into savings and investments before the lifestyle has a chance to adapt to the new level. Research in behavioral economics consistently shows that pre-commitment strategies are dramatically more effective than relying on willpower in the moment. Deciding that 50% of every future raise will go to investments and automating that transfer before you ever see the money in your spending account is the single most reliable way to ensure that income growth actually translates to wealth growth rather than lifestyle growth. If these numbers are landing differently than you expected, please take a second right now to hit the like button and subscribe to this channel. Every week there is new content designed to give you the kind of honest financial clarity that actually changes decisions. It is always free. 2 seconds right now. Now let's keep going. The compounding cost over different time horizons. Let's get even more specific about what lifestyle inflation costs across different time horizons and different spending levels, because seeing these numbers laid out concretely is the most powerful argument against allowing lifestyle to absorb income growth. Consider someone who upgrades their car at age 28 from a paid-off vehicle to a leased car costing $350 per month and maintains that car payment, upgrading to a new lease every 3 years until age 58. The surface cost of those 30 years of car payments is $126,000. The opportunity cost, what that $350 per month invested at 10% annually for 30 years would have grown to, is approximately $790,000. The car payments did not cost $126,000. They cost $790,000 in retirement wealth. Now consider a series of smaller lifestyle upgrades at age 30, a nicer apartment, more frequent dining out, premium streaming services, better clothing, that together add $500 per month to monthly spending compared to what was previously perfectly comfortable. If that $500 is directed to investments instead from age 30 to age 65 at a 10% return, it grows to approximately $1.9 million. The lifestyle upgrades that felt worth $500 a month actually cost $1.9 million in long-term wealth. And consider the most powerful example of all: a person who keeps their lifestyle costs flat at age 25, despite a steadily growing income,
resisting lifestyle inflation for just the first 10 years of their career, from 25 to 35, and invests the entire difference, then allows their lifestyle to grow normally from 35 onwards. Compared to a peer who allows lifestyle to absorb all income growth from age 25, this person arrives at retirement with a portfolio that is often 2 to 3 times larger, having made no additional contributions after 35. The discipline of resisting lifestyle inflation for just 10 years in your 20s generates more wealth than most other financial strategies available to an ordinary person. What lifestyle inflation looks like in practice. Common examples. It is worth being specific about the most common forms lifestyle inflation takes, because recognizing the patterns in your own life is the first step toward managing them deliberately. Housing is the largest single category of lifestyle inflation for most people. The move from a functional but modest apartment to a nicer one, from a one-bedroom to a two-bedroom that is not yet needed, from renting to buying a home at the top of the mortgage approval range, each of these is a form of housing lifestyle inflation that can add hundreds or thousands of dollars to monthly fixed costs in ways that are very difficult to reverse. Transportation is the second largest category. The move from owning an older, paid-off car to leasing or financing a newer one, from one household car to two, from an economy model to a premium one. These decisions lock in monthly costs that compound for years and carry the significant opportunity costs we calculated above. Food and dining is perhaps the least gradual and least noticed category. The shift from cooking most meals at home to dining out 3 or 4 times per week, from buying mid-range groceries to premium ones, from making coffee at home to buying it daily. Each individual shift is small. Together, they can easily add $400 to $600 per month to spending without ever feeling like a significant lifestyle change. Subscriptions and convenience spending have become a growing category of lifestyle inflation in the last decade. The accumulation of streaming services, delivery apps, premium software subscriptions, fitness services, meal kit deliveries, and convenience-driven spending can quietly add hundreds of dollars per month to the cost of living in ways that feel invisible because each individual charge is small and automatic.
How to manage lifestyle inflation without feeling deprived. The goal is not to live like you were poor when you were not. The goal is to make lifestyle growth a conscious choice rather than an automatic default, and to ensure that income growth genuinely improves your financial position rather than just upgrading the cost of the same financial stagnation. The most practical approach is what some financial planners call the half-and-half rule. Every time your income increases, a raise, a bonus, a new job, additional income from a side project, you commit in advance to directing half of the net increase to savings or investments and allowing your lifestyle to absorb only the other half. This ensures that income growth genuinely moves the needle on your financial position while still allowing your lifestyle to improve meaningfully over time. The improvement is real. It is just slower than consuming the entire increase at once. And the financial difference between these two approaches, compounded over a career, is enormous. The second approach is to conduct a periodic lifestyle audit. Every 6 months, sit down with your bank and credit card statements and categorize every recurring expense, asking honestly whether each one adds genuine, lasting value to your life relative to its cost. The gym you never use, the streaming service with 3 shows you watch, the subscription box you stopped being excited by in month 2, the premium version of an app that the free version would serve equally well. Most people who do this audit consistently find several $100s of monthly spending that has crept in through lifestyle inflation and could be redirected without meaningfully reducing the quality of their daily life. Lifestyle inflation is not a character flaw. It is a natural human response to improving circumstances, the desire to enjoy the fruits of hard work and growing income. The problem is not wanting your life to improve as your income grows. The problem is allowing that improvement to happen automatically and entirely, with no deliberate allocation of income growth to the investment and savings that build long-term financial security. The numbers we went through today make the real cost of that automatic approach impossible to ignore once you see them clearly. A $1,000 per month lifestyle upgrade at age 30 does not cost $1,000 a month. It costs $3.8 million in compound wealth by retirement. Seeing the true cost of decisions through the opportunity cost lens, what would this money become if invested instead, permanently changes how those decisions feel, not into paralysis or deprivation, but into genuine, informed choice. The resources in the description below include calculators and tools that will help you run these opportunity cost numbers for your own specific lifestyle and income situation. Seeing the numbers with your own figures is even more powerful than seeing general examples. Drop a comment and tell me, is there a specific lifestyle upgrade you have made recently that you are going to look at differently after this video? I genuinely read every comment and I find these reflections valuable. And please subscribe to this channel if you have not already. New content every week, always free, always honest. If this video changed how you think about spending and income growth, the next one is going to hit just as hard. We're getting into why saving money feels so impossibly difficult for so many people today, the structural, psychological, and systemic reasons that make saving genuinely harder than it used to be, and what actually works for building a saving habit in the current environment. I think you will find it both validating and genuinely practical.